Hello and welcome to this programme from Baillie Gifford, the latest in a series of webinars where we talk to the representatives of the business's different investment funds. And today we're talking to Rosie Rankin, who is an investment specialist on the Baillie Gifford Positive Change Fund. So thank you for joining us, Rosie. Let's talk about the fund from its fundamentals and the title, the Positive Change Fund, and its stated aim to contribute to a more sustainable and inclusive world. Different people will have different views on exactly what that means. So let's start by asking you, what does Baillie Gifford take it to mean?
Yeah, great place to start, Richard. Yes, so positive change has two equally important objectives: attractive investment returns, and that's really easy to define because it's 2% per annum ahead of the MSCI ACWI over rolling 5 years. But you're right, what does contribute to a more sustainable and inclusive world actually mean? Well, to us, we have 4 clear impact themes. So we're looking for companies whose products and services are helping to meet challenges in the areas of 1, social inclusion and education, 2, environment and resource needs, 3, healthcare and quality of life, and 4, base of the pyramid. Now, what do I mean by base of the pyramid? Well, it's looking for companies who are helping those at the very bottom of the global income ladder. So the 4 billion people or so who are on less than $3,000 a year. So it's looking for companies whose products are helping meet challenges in those areas.
Okay, well, you had both sides of it there, the aim to beat your benchmark and the aim to do good. So let's just talk a little about the basis that you elect companies to get into the fund. Is it a balance of subjective and objective criteria, or how, if I was running a fund, would I persuade you that my fund should be in there?
Yes. So yes, if you were running a company, what exactly are we looking for? So as I said, both objectives equally important. So in terms of that investment perspective, we're looking for well-run businesses who have a clear and strong competitive advantage, who have good financial characteristics and are attractively valued, and who we have confidence can achieve a doubling of share price on a 5-year view, and for that doubling to be driven by the fundamentals of the business, so that kind of revenue and earnings growth coming through. And we also want that company to be contributing towards a more sustainable and inclusive world. And one question I'm often asked is, but is there a tension between your two objectives? And for us, we're looking for companies where there's not a tension, but actually there's a synergy, because what we want is for the products of the company that are driving that revenue growth to be the products that are also contributing towards change. So to give you a really simple example, we invest in Duolingo, the language learning app. As they attract more users to the app, they will attract more advertising revenue, they'll get more paid subscribers. That is going to drive their revenue and ultimately earnings. That is also what's going to drive their impact as they expand the number of learners that they're benefiting. So we're looking for that clear synergy. And of course, to come back to your question, there is a mix of very objective criteria. You can measure things like number of learners, but you do have to overlay that with a subjective understanding of what does it actually really mean for someone in an emerging market, for example, to be able to learn a language for free. What does that open up for them in terms of educational or employment opportunities? So it's a mix of a very kind of strong objective basis with a subjective lens and understanding on top of that.
Right. So, and how do you tease out those subjective measures in looking at a company like Duolingo, for example?
Yes, absolutely. So, when we're looking at any company, we look at 3 factors when we're thinking about their impact. So we want to think about intent, we want to think about product impact, and we want to think about business practices. So for something like intent, this is really trying to get beyond a company's mission statement. Every company tends to have quite an inspiring mission statement, but actually thinking about what's the real intent of this management team? Does it go just beyond profit maximization? Do they really want to drive a positive change in the world? Are they trying to make a difference? And you have to look at evidence points in terms of how they are targeting their products and services, what industry initiatives they're participating in, how they're really trying to drive forward a positive contribution to the world. And then in terms of that product impact, I guess this is where it gets really interesting, because what you can actually measure isn't necessarily the most exciting change that the company is driving. So to give you a different example, we invest in a Brazilian bank called Nubank. We know that they have close to 100 million customers now, around 10% of which it's their first ever bank account. So that's the measurable bit. But then you think, what difference has it made to that 10% of their customers having access to financial services for the first time? And that's when we have to do more work to understand on a more qualitative basis, actually, how has this kind of improved or otherwise people's lives.
Right.
So yeah, there's no shortcuts in this type of work, which is why I think running an impact fund like this is very resource intensive.
Right. So you've got over those two hurdles for the companies you look at. Then you've got to think about how can this make the returns that your investors are looking for. Is that straight back to financial analysis?
Yes, and often those two pieces of work are done concurrently. So the way that the positive change team is structured, there's 10 in the team who all work full time on positive change. It's actually one of the largest investment teams at Baillie Gifford. 6 are investment managers and analysts, and 4 are impact analysts. So when we're looking at a company, we will have an investment expert looking at the investment characteristics of the company, and an impact expert looking at the impact characteristics. And it's only when we're satisfied that a company can meet both their objectives that we will invest. So if we see a company that's doing something very beneficial for the world, but we don't think it will make attractive investment returns, we won't invest, and vice versa. So a company does have to meet both criteria. And ideally, as I said, there'll be that synergy between what is going to drive long-term returns and what is going to drive the positive impact.
Okay. Obviously, no firms are ever all good or all bad, and you've always got a balance. So I'm just curious about how you balance out these factors. So you might look at a company like TSMC, a very major holding in the fund, produces cutting edge chip equipment and fabs, and doing some very positive things for the world, bringing the world together and helping them communicate better. But it uses an awful lot of water, it uses an awful lot of energy to make its products. So how do you balance those factors out when you're talking to a company?
Yeah, and that's actually a really good example there. And you're absolutely right in terms of there is no perfect company. This is not a portfolio of perfect companies. If we were holding out for a portfolio of perfect companies, I don't know what would be in it. But in terms of looking at companies, it's being really clear about the positive change that they're driving, but also really clear about any negative impacts of either their products or their business practices. And as you said, TSMC is world leading in terms of its manufacture of semiconductors, which are used in such an array of products driving positive change, but it is very energy consumptive and it does use a lot of water. And in that case, before we invest, we want to investigate actually how is the company themselves thinking about these huge challenges. And it's really encouraging that TSMC are very aware of their energy usage and water consumption. They've been very active in engaging with shareholders like us. They've set very clear targets. So despite the fact that TSMC is growing its operations by 2030, it wants to reduce its greenhouse gas emissions by 30%. It wants to have 40% of its energy coming from renewable sources. And similarly, by 2030, it wants to reduce its water consumption by about 30% and also use much more reclaimed water. So it's being really thoughtful about the challenges, setting really clear targets that we can monitor, and being open to engagement. And I think that's what we want to see from companies, is acknowledging where they're having any negative impact and being proactive about addressing those and open about it. And in turn, we have to be open with our clients about any negative impacts of companies, and we do that in our reporting.
Right. Well, you brought up a very interesting point there, because companies have targets and intentions, and that's great. But once a company is in your portfolio, you can talk about TSMC or any other company that you want, how do you ensure it stays true to the qualities that made you invest in it in the first place?
Yeah, because again, you're spot on, because it's very easy for companies to set targets, but then how do we keep them honest to that? So you can monitor a company's progress by the metrics that it publishes, either through its quarterly results or its annual sustainability reporting. We are also very active in engaging with companies. So last year, for example, we met with every company in the Positive Change portfolio to have conversations, because again, it's that mix of having the metrics that you want to measure and see progress against, but also understanding perhaps the challenges around that, or what the company's intentions are thinking about that. So yes, it's very much about monitoring the numbers and speaking and engaging with the companies about what's happening behind the numbers, the story behind the numbers.
And do you feel that companies, I mean, we've obviously had international accounting standards for years, and more or less every company that you'll invest in will stick to those, but are there similar KPIs for social measures and environmental measures that enable you to compare one company and another?
So it's not as straightforward as international accounting standards, sadly, but of course they took many hundreds of years to develop. We are seeing a lot of development in metrics, which is pleasing. I would point to, particularly on the environmental side, we're seeing not quite standardization, but definitely more progress in that area. On the social side, there's much less standardization, but I think the role that we can play as investors is encouraging companies to report, engaging with companies, not just to encouraging them to report, but to talk to them about the frameworks that we would find useful and that other investors find useful. Because often within the portfolio, we may be investing in a relatively early stage company that's just come to the public markets and is grappling with the array of reporting demands being asked of it. So they're thinking, how do I navigate this? What's the material ones for me? So yeah, I think we're definitely seeing progress there. And we're seeing companies wanting to report as well, which is good.
Yeah. So let's just turn to the fund itself and its performance. It has been a tough 3 years for the fund. Why do you think the fund underperformed the benchmark, and did it raise any questions? Did it make you think about changing the strategy, having lived through this difficult period?
Yeah, no, you're absolutely right. It has been a tough 3 years for the fund. So if you had invested 3 years ago to the end of May this year, your investment would have fallen by 10%. That is in huge contrast if you had invested 5 years ago to the end of May, when your investment would have risen 95%. So there's been a very different experience depending on when you invested. Over the last 3 years, there are a few factors. I think one is the general market environment. We definitely saw in the latter part of 2021 and 2022 long duration growth stocks of the type that we very much favour being out of favour with the market. And we saw a real disconnect at that point between the fundamental progress of some of the companies in the portfolio and their share price performance. And then, of course, in more recent months, we've seen incredible market concentration and excitement around a few names, which dubbed the Magnificent Seven, where we've seen a lot of the market performance concentrated in those names. Of that Magnificent Seven, we have one in the portfolio, Tesla. So that's one reason. I think in terms of other reasons for relative underperformance, of course, some companies have not worked out. Some of those companies we've taken the decision to move on from. I would point to companies there such as Ørsted, the Danish renewable energy company, or Berkeley Lights, a biotech company. So some have not worked out. And for other companies, they are absolutely working out, but we feel they're a bit unrecognised by the market just now. Moderna is a great example there. It's actually come back in share price terms a bit more recently, but has definitely been in the doldrums over recent years as the market have focused on declining COVID revenues, despite the fact that it's making really good progress across different areas of clinical trials.
Okay.
So I guess that answers the first part of your question in terms of the why, a few reasons there. The second part of your question was that, so, well, what have we done about that? What are, probably first of all, in terms of what we haven't done, is we haven't changed our philosophy at all. We're very much focused on investment returns and having a positive impact over the long term. So clients can be really confident that we've not changed that. In reflecting on lessons learned, the last 3 years have really shone a light on the importance of execution. We like investing in ambitious management teams, but the ability to execute on that ambition is so important. And arguably, when we look at companies where things have gone wrong, it's been that execution point that's where they've perhaps faltered. So that's shone a light from that. So that's an area we'll definitely be focusing on in future. And I think also it's just about recognising that we absolutely want to have young, early stage companies in the portfolio. When we look back, it's many of those that have driven investment returns. But particularly when they enter the portfolio, we want to make sure that they're going in at a relatively small position size, really to reflect that initial risk as well. So companies such as Joby Aviation, which is an early stage electric aviation company, or Rivian, the electric vehicle company, have gone into the portfolio recently, but at a 0.5 position size, so just 0.5%, which allows us exposure to the potential of that name, but without taking undue risk.
Okay, so we've had a quick review of the last 3 years. What makes you think the next 3 years will be better?
Yes, we very much hope the next 3 years will be better because fundamentally at Baillie Gifford, our view is, as long-term growth investors, that over the long term, your share price will follow the fundamentals of your business. And what do I mean by that? It's that over that 5-year view, share prices will be driven by the revenue growth and the earnings growth of the companies in which we invest. And if you look at the positive change portfolio, it's a portfolio of companies with really strong fundamentals. So the predicted revenue growth over the next 3 years is about twice that of the benchmark. Similarly, predicted earnings growth over the next 3 years is about twice that of the benchmark. And it's a portfolio that's really investing in its future growth as well. So if you look at the kind of innovation ratio and the amount that companies are spending on R&D as a proportion of revenue, that's high. It's a portfolio with low levels of debt. So you just look at this portfolio and think, this is a portfolio poised for growth. The $1 million question is when, and I can't answer that.
No, fair enough. No forward projections, please. What we can talk about, which is going to be very big over the next 3 years, is already starting to be very big, is artificial intelligence. And you can talk about the opportunities that it provides. Does it also threaten some of the stocks you have in the portfolio? I mean, I'm thinking, let's take Duolingo again. I mean, I can get my language lessons in all sorts of form from ChatGPT. Is this a threat to some of the companies that you own?
So I think when we're looking at AI, we've got to look at it with a really open mind in terms of, all of us are just at the early stages of realizing that potential of AI, what it means for our businesses and lives, both in terms of the opportunity it presents, but also the risks. I think for Duolingo in the short term, it would definitely provide more of an opportunity than a risk. They are using AI within their language learning to great effect, whether that's to simulate conversations, it's to tailor individual lessons based on a user's previous mistakes. So they're using it to great effect. Looking out very long term, what will the future of language learning be? Will AI provide simultaneous translation for us all so that language learning diminishes? That's a much more kind of longer term threat. But I think when we're thinking about AI within the portfolio, it's more excitement than threat that we're really seeing. I referenced earlier the Magnificent Seven, and a lot of that performance and excitement we're seeing around those companies is due to artificial intelligence. But I think it's completely wrong to view artificial intelligence as being a story of 7 stocks, because actually when you look across the portfolio, we see companies such as you mentioned TSMC or ASML, which are critical to the infrastructure of artificial intelligence. Or you look at companies which are using artificial intelligence to solve challenges, whether that's something like Deere with precision agriculture or Moderna using artificial intelligence to help develop new therapies. And you also need companies which are helping make AI sustainable. Data centers use incredible amounts of water. So we have companies in the portfolio such as Xylem, which is a water infrastructure company, which helps data centers use water more efficiently. So I think it would be wrong to dismiss any threats from artificial intelligence because we're just at the start of understanding what it can do. But I think at the moment our excitement, it outweighs that.
Yeah, I mean, it is in the name of the fund about positive change and making the world a better place. And there are some people out there, some eminent scientists who say that, AI is a threat to us all and the very existence of the world. How do you take that on board, and how does that drive what you do and trying to make the world a better place?
Yeah, I think you're right. At the core of what we do is we have to be optimistic, because when you look at the world today and look at some of the really critical challenges that we face, whether that's around climate and extreme weather, whether it's around geopolitics and conflict or social inequalities, it could get overwhelming in terms of thinking about the challenges that we face. So within positive change, what we endeavour to hold on to is that optimistic mindset that human ingenuity will allow us to solve and address some of these challenges and move forwards. And of course, you always have to be cognizant of the risks and the threats that we face in so many realms of our lives. But in order to move forward and progress, you have to have that hope and optimism that ingenuity will provide a solution.
Excellent. We're coming up to some readers' questions in a minute, so just one more from me, and that's, you outlined a bit earlier your 4 areas of interest: social inclusion and education, environment and resources, healthcare and quality of life, and base of the pyramid. Is the portfolio divided more or less equally into those areas, or is there any one that you see offering more scope, both from the sort of impact vision of the fund and the investment return impact of the fund?
Yes, so we don't take a top-down view. So we don't sit back and say, okay, we want 20% in this theme and 40% in that theme. Exposure to the themes will happen in a very organic way, depending on where we found ideas. At the moment, social inclusion and education is the largest theme within the portfolio. It's about 40%. So as well as having education companies in there, such as Duolingo and Coursera, we have companies such as Nubank, which I mentioned, the Brazilian bank, HDFC, an Indian bank, companies such as ASML. But if you went back 4 or 5 years, it was healthcare and quality of life, which was the largest theme. It was about 40% at that time, reflecting many of the healthcare opportunities we saw. So it will ebb and flow over time in terms of that allocation to different themes.
Right. So there's no top-down decision to allocate between those different themes?
No. The themes are really useful in terms of helping us with our research agenda. So we are looking at areas such as the energy transition or sustainable agriculture. And the 4 themes are also very useful as a framework for reporting our impact. So if you look at our annual impact report, it's divided into those 4 sections, but we don't use it for top-down allocation.
Right. Excellent. Going to come to a few questions from the audience now, and a couple to do with ESG. The fashion for ESG funds came a few years ago and then has dropped off suddenly. So is it much harder to persuade investors, whether at the wholesale or the retail level, that an impact fund as yours should be worth considering? Has that ESG story been and gone?
No, I think your reader who sent in the question is absolutely right in terms of it has gone, in the decade I've been working in the area, it has gone from being very niche to being a completely hot topic, to being there's more skepticism, but it certainly hasn't changed the demand that we're seeing for positive change more broadly. And I think the reason for that is because there is such a synergy between actually what is going to be the big structural growth drivers looking at over the next 2 decades. So strip it all back, strip all the terminology about sustainable, ESG, responsible, and actually just think about what has driven growth over the last 2 centuries. And it's been the big transitions that we've seen. So whether you're going back to industrialization and the huge amounts of capital that were made as the world industrialized, or electrification, or the dawning of the railway age, or oil and gas, and actually looking forward, what is going to generate similar levels of prosperity and growth over the next few decades. And we truly believe it's this transition that we have to make in terms of the energy transition, how we actually live our lives in ensuring that there's peace and stability and social inclusion, and all these factors from our perspective aren't nice to haves. They're intrinsic to the continuing prosperity and stability of the planet.
There's a lot of E and S out of the ESG in the way you pick stocks, but she saw very little reliance on G, the governance of particular companies or indeed the countries where they operate in. Is governance an important factor for you?
Yes, it is. So, of course, a company is in the portfolio because of its product impact. But when we're looking at the business practices, which is one of the pillars of what we assess before we invest in a company, we're looking at the E, the S, and the G, because ultimately we're investing in a company for 5 to 10 years, perhaps longer. So governance factors are really important in terms of thinking about how a company will ultimately thrive over the long term, that it's got appropriate governance structures in place. And when we're doing that analysis around a company's governance structure, we do want to be very aware of where a company is domiciled, what stage it is at in terms of its maturity, to make sure that it has appropriate governance structures in place for that stage of its growth. So yes, your viewer is absolutely right. I hadn't actually mentioned it so far today, but it is something that's a kind of intrinsic part of our analysis.
Okay. Couple more questions that as we wind up, more about the sort of technical composition of the fund and how you go about making the portfolio. And the first one is, how long do you monitor a potential investment before buying into it? And then you've stated the aim is to hold these companies for a long time, but what is the average investment holding time for your portfolio?
Yes, so in terms of that first question about how long do we monitor a company for before investing, that can really vary from a number of months. You know, we can start to look at a company, be very enthused and think now is absolutely the right time to invest and invest after a period of months. Or it may take us a few years to get comfortable. And when I say get comfortable, it may be because we are waiting just for evidence that the company is making the progress that we would expect from an operational perspective. Or it may be waiting for an opportunity to invest from a valuation perspective. One of the companies in the portfolio, Remitly, for example, we looked at it at IPO, really liked the company, but felt it was quite richly valued at IPO. So we waited a few years to invest until there was an attractive entry point. So we will be patient where we're either waiting for evidence of progress or waiting for an appropriate valuation.
Okay. I mean, sorry, carry on.
Yes, and the second part of the question was just about how long do we hold a company for. So we are a low turnover portfolio, so turnover is typically below 20% per annum, which is very consistent with our 5-year holding period. And around half of the companies in the portfolio, so we typically have about 35 companies in the portfolio. So 16 of the companies we've owned since the very inception of Positive Change, which was January 2017. So we've owned for over 7 years. So yeah, we are very long term.
And you mentioned something there about the IPO for Remitly and it being a rather rich valuation. I mean, does it worry you that so many companies now come to IPO at such rich valuations, and in a sense, a fund like yours might miss out on the real value added of investing in a company?
No, I think we absolutely just approach it on a case-by-case basis. Some of the companies that we have participated in at IPO, and it's something that we like doing within an impact fund because, of course, you're supplying primary capital, have worked out extremely well. So some of the top contributors to performance, whether that's Nubank or Moderna, we participated in at IPO. And then other companies have been much less successful, but that's part and parcel of our investment approach. And the ones that have been successful have far outweighed the ones that haven't.
Excellent. I think we're coming up to the 22:03 mark, so I'm going to wrap up there and say thank you. It's all we've got time for today. So again, thank you, Rosie, for your time and your insights. We do have more sessions like this coming up, so please do keep an eye out for those if you found today's useful. And until the next time, thank you and goodbye.